What's up everybody, Nate here, and the Federal Reserve is gearing up to make a huge announcement concerning its interest rates sometime very soon. Now, its interest rate policies affect everything in our entire economy, from the way consumers spend money to the way that businesses and investors invest their money. So based on what the Federal Reserve does, this could have a massive impact and a massive rippling effect throughout our entire economy. So today, I want to go over what we can expect from the Federal Reserve. I want to talk about how its decision is going to affect the housing market, the stock market, and the cryptocurrency market, and more importantly, how all of this is going to affect you and your wallet. So let's start with what we can expect from the Federal Reserve on Wednesday. Now, right now, the Federal Reserve has its FOMC meeting where it's going to go over all of the numbers in terms of inflation and job employment, and these numbers are going to tell the Federal Reserve what to do with its interest rate policies, whether they're going to raise their interest rates or whether they're going to lower them. Right now, most Fed governors are saying that we're going to see a Federal Reserve interest rate hike, including Federal Reserve Chairman Jerome Powell. They have talked a lot about how inflation is still entrenched in our economy, and the only thing that's going to bring it down is raising its interest rates. So they are going to be most likely raising their interest rates on Wednesday. This is because inflation still sits at around 7.7% in our economy, and the jobs numbers are still extremely strong. The unemployment rate in the economy right now sits at around 3.7%, which is still way too low for the Federal Reserve. They have to bring down demand for everything in our economy, and by raising their interest rates, that means that consumers are going to have a hard time getting loans because the interest rates are way too high. They simply can't afford it, and the same can be said for investors and businesses. Taking on that debt is going to be a lot more expensive, so investors aren't going to invest their money if it comes with a high expense and really high risk. So that means everything in our economy is going to be shrinking the higher and the more aggressive the Federal Reserve gets with its interest rate policies. But we have seen the Federal Reserve talk a lot about how their interest rates are starting to have an effect on our broader economy. We are starting to see inflation slowly come down in the United States, which means the Federal Reserve can kind of look at what it's done so far and realize that demand is starting to slowly go down, so it may not raise its interest rates that aggressively in its next meeting. So we might actually see a much more reserved Fed rather than a Federal Reserve that is being aggressive. And that is good news for the stock market and a lot of our other markets. It means the Federal Reserve might start cooling down because our entire economy is also starting to cool. Many experts and investors agree that we might only see a 50 basis point hike instead of the 75 basis point hike that we've seen pretty much all throughout 2022. The Federal Reserve has been hiking interest rates really fast and aggressively because they want to lower inflation very quickly, but that also means that we could also run into some pretty bad economic issues in the future. So they have been really careful, but now they're kind of looking at what everything has done so far, and they realize that it might be time to start cooling off their interest rate hikes. Now, in terms of how all of this is going to shape up for the rest of our economy, well, the stock market loves to hear that the Federal Reserve may slow down, and the stock market actually believes right now that the Federal Reserve is going to reverse a lot of its policies, actually lowering interest rates into 2023. The Federal Reserve has talked a lot about how they have had an effect on inflation so far, and if the Federal Reserve believes that they're going in the right direction and our economy is going in the right direction, then that could mean that lowering interest rates is appropriate next year. The stock market is banking on this, and it's actually started to go way up in preparation that businesses may start booming. The Federal Reserve can lower demand by raising its interest rates. Like I said, that means all of these consumers and all of these businesses are going to have a hard time getting and spending money. But if the Federal Reserve starts lowering their interest rates, well, then that means everything is going to boom again. Remember what happened over the last couple of years. Interest rates were set at around 0%, and that meant that so many consumers went out and got a house and went out and got a car because money was really easy to borrow and money was really easy to come by. So the stock market is hoping to bank on that in 2023 and hopes for all of this business expansion because investing and consumer debt and debt in general is going to be really hard to come by, which means more profits and more growth for them. That could usher in a new era of spending. Now, the Federal Reserve has not directly said when they're going to lower their interest rates again, but if the Federal Reserve actually does slow down their interest rate hikes, that could be a pretty clear indication that we're getting a lot closer to actually lowering rates in the near to distant future, which is great for the stock market because everything could then go up because spending will ultimately rise. As for the housing market, well, the housing market will most likely explode as well if we do see interest rates go down. So far, just on the talk of interest rates going down from the Federal Reserve, interest rates for a 30-year fixed mortgage on average have decreased in the United States, and more buyers have started to enter the market. Now, what we've seen overall is not enough buyers still able to afford a home because prices and interest rates are still way too high. But if those interest rates start to come way down, that could mean more buyers enter the housing market, and we still don't have enough supply or homes on the market, meaning prices go way up once again. Over the past few months, we have started to see prices come down in most markets because demand is slowly getting sucked out. Like I said before, the way that you're able to afford a mortgage is based on that interest rate, and if interest rates are getting into the 6th and 7th percentile mark, well, then that means millions of Americans simply are going to be priced out of the market. They're going to pay an extra $2, $3, $4, and even $500 plus on a mortgage simply because that interest rate is really high. So with those rates going up, people have been sucked out of the market, and that gives supply a little bit of time to come up in the housing market, but we really haven't seen that just yet. Low interest rates would mean that more people would be interested in buying a home, meaning supply would also start to rise because builders are going to start creating more homes and people have a reason to sell their house once again. Now, cryptocurrency is a little bit more complicated because we have seen basically the fall and crash of cryptocurrency all throughout 2022. And what you've got to keep in mind is investors are risk adverse here, right? When interest rates are going really high, investors don't want to borrow money. They don't want to spend their money on things because they're not sure they're going to see a profitable return on their money. And the same thing can be said about cryptocurrency. Cryptocurrency is super risky in the first place, and with interest rates going up, that creates an even more risky situation for a lot of investors. So they want to push away from that. But if interest rates actually go down, if interest rates start to slow down into 2023, that could mean more buyers and more investors actually go back to the cryptocurrency market. But like I said though, cryptocurrency is pretty complicated because we've also started to see the fall of a lot of exchanges, meaning there's not many places for cryptocurrency investors to go back to. That could mean your existing cryptocurrency exchanges like Binance and Crypto.com and Coinbase start to explode in value because they're really the only ones available and the only crypto exchanges that are trustworthy and good out of all of the bad ones. So those stocks and those exchanges could explode in 2023 if interest rates slow down or if they go down. Now, like I said, this all assumes that the Federal Reserve is going to lower interest rates or slow down interest rates, and that is basically the expectation right now. But you and your finances can't go off of expectations. You need to be prepared for whatever happens. If the Federal Reserve actually raises interest rates continually and aggressively because that is what the numbers dictate, well then we could see some difficult situations in 2023, and you need to be prepared for that. There is nothing saying the Federal Reserve can't raise interest rates even more. They have said in the past that, well, there's a potential that we could go down soon, and then they raise interest rates aggressively right after that. What they say is not set in stone, and the data is changing all the time. If the Federal Reserve was to actually raise its interest rates by 75 basis points or higher this week, then that could mean the stock market actually goes way down or is extremely volatile. The same with the housing market and the same with the cryptocurrency market. And all I'm saying here is if you invest on expectations alone, then you're gonna get burnt more often than not. Now, what this means for you and your money is that you need to be prepared with your finances. We don't know what's going to happen in 2023, and if the Federal Reserve continues to raise interest rates like they're most likely going to do, although it might be at a slower level, we could see a lot of job loss. This is what the Federal Reserve wants. They need fewer people employed because the more people that are employed, the more people can buy things. As people got hired in 2021, they made a lot more money, and right now we have companies that are hemorrhaging cash because their employee base makes way too much money, and that's a big problem because inflation is driven by all of those people making a lot more money. So the Federal Reserve wants to reduce the number of people that are employed by raising interest rates. Businesses won't be able to get any of that investor cash anymore. They won't be able to take on any debt to grow, so they're going to have to downsize. They're going to have to cut people, and with people getting cut, they will no longer have an income, and if they don't have an income, they can't buy things, meaning demand for products and services will go down, thus prices will go down. So you have to be prepared ahead of time with your finances, and the way you do that is by doing three major things. The first is by saving your money. You need to have some type of emergency savings here that is the baseline to your finances, because like I said, we don't know what's going to happen in the future, and if you were to lose your job, then there goes your income, and there goes your ability to pay for bills and other expenses. If you run into that situation, then you're going to have to put all of that money on credit, which is going to put you into further debt, which is going to hurt your chances of building wealth in the future. So you have to have some kind of baseline for your finances. I recommend around $2,000 to $4,000 in a savings account. That is going to protect you against most of life's disasters, and if you don't have that money saved and set aside, then you are one financial disaster away from financial ruin. Once you've saved up that $3,000 to $4,000, now you can save even more for 3 months worth of all of your expenses and up to 6 months. The point here is that you're protecting yourself against something that could potentially happen in the future, like job loss or a major life change. The second thing you're going to want to do is pay attention to all of your money management. You have to be careful what exactly you're spending your money on. This is not the time to go into a lot of debt buying something that you've always wanted. You have to be very careful with what you spend your money on. Blowing your money in 2023 might be a huge mistake, and when I say blowing your money, I mean spending your money on something that you can't afford in the first place. All that is going to do is amplify your debt, and it's going to keep you from saving money, and it's going to keep you from investing money. Living paycheck to paycheck is not what you want to do during a recession, because it's just going to keep you down and damage your finances in the future. So basically just ask yourself, can I afford this? You have to be really thoughtful with your finances, and that's going to be very important in 2023. Because if you push yourself to the limit, well, like I said, nobody knows what's going to happen again, and we can bet that overspending could ultimately become your downfall. So create a budget that works for you and then stick to it, and make sure that every single dollar that you spend is accounted for in your financial plans. And basically the way that I look at it is, if it doesn't go towards your long-term goals, then it might be time to kind of put it away in the short term. And finally, you need to continue investing your money. This is the most important thing that you can do, because every time you invest your money, you are essentially beating inflation, and you're essentially protecting yourself and building your wealth for the future. Your money has to be put to work here, and it has to do something for you rather than just sitting in a savings account, and rather than just being spent on something that's just going to keep you poor. There are going to be lots of opportunities to invest your money. If we do start to see really high interest rates into 2023, then the stock market is most likely going to go down, and same with real estate, and this could be an opportunity for you to come in and buy big at a discount. That alone is going to help your finances grow next year, and potentially you might build so much wealth that you don't even have to worry about a recession down the road. Yes, nobody likes to see a recession, and a recession means a lot of loss for our economy, but it could also mean big opportunities for those with the right mindset. Like I said, the end goal here is just for you to be prepared, because you can't expect anything from the Federal Reserve, and we can't wait for something to happen before we do something with our finances. If you put yourself in the right position today, then tomorrow you'll be in a much better position to handle the next recession, and then the next recession. And eventually, you'll be on the path towards financial freedom no matter the economic conditions. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.